and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Sanjay Chawla, CIO-Equity at BNP Paribas Mutual Fund. Sanjay, good to have you back with us.
Thank you, Ruchira, and thank you, Chirag, for having me on the show.
So even though the markets are up in the current calendar year, but in the recent past we have seen some bit of correction in the market. Do you think it's a buying opportunity, or do you believe that the valuation is still high in some segments of the market?
Sure. So, Chirag, that is true. I mean, we have seen some correction in the equity markets in recent times, probably driven by the global factors. And we've seen this kind of a correction across the cap curve. Uh, because of the higher volatility in the international market, the earnings seem to have been impacted across the market curve, especially for the small cap and mid cap. The large caps have been relatively less volatile. I can argue that part of this correction is also because of the earnings growth slowdown that we had witnessed in quarter 1 of this financial year. And we'll probably see a similar kind of a tepid growth in quarter 2. This earnings growth that we are really talking about, slow earnings growth in quarter 1, which is an actual number, and quarter 2, where the expectations are there, the reasons are quite different. In quarter 1, we had seen the elections happening and the heat wave, which probably resulted in some bit of a slowdown in the economic activity. In quarter 2, there's little bit of a spillover happening from the what was actually happening in the post-election in terms of the ministries being settling down, etc. And you also need to appreciate that in this quarter, there have been no festive season. Unlike last year, where there were some festives which actually happened in quarter 2. So this time around, all the festives have been bunched up in quarter 3 per se. So yes, I think there is a slight correction which is there, but I would tend to believe that these are temporary in nature. In terms of the overall valuation, I do believe that markets are trading at the last 10-year averages per se in terms of the forward numbers. The question that you should be asking is, given the fact that they're trading at the last 10-year averages, are the earnings growth aligned to that 10-year average? I do believe that there's some bit of a earnings cut that we may see in the coming times because of the slower first half than expectation.
Right now, you've navigated many market cycles over the years. So, what's the most important lesson you have learned from managing through both booms and downturns?
So market always goes through a cycle. While the fair value has been a fair value of a company or a market is probably constant, ceteris paribus, the focus always should be on the fundamentals of the company, right? And not really on the stock price movement out there, which is where you have a lot of booms and the busts happening. So in my last 34 years of my presence in the market, I've seen multiple cycles out there. You know, I tend to call myself as a child of the bear market because in the early 90s, you had a cycle where the bull market cycle was a relatively short cycle and the bear market was usually longer cycle. So I'd witnessed some of the bust which actually happened. The more recent one was, of course, the COVID. Prior to that, you had the global financial crisis. Prior to that, you had two scams which led to a prolonged bear market in the country. Besides these kind of busting, you also had the Asian financial crisis, right, which was a region specific out there. And post each of these events, through the entire cycle, it's left a deep impression on me. There were key learnings, which has actually helped to improve the investment style. Besides this, you also have cycles like post the Y2K, you had the IT cycle going down. So that was another interesting lesson. And, why go so far? In recent times, we had seen a big run up in the defense sector names also. So those were the interesting things that we have in terms of the cycles. It's very important to understand why does the market go through these cycles and what are the factors in terms of are they permanent in nature, are they structural in nature, or they are temporary in nature out there. Uh, Throughout the entire cycle, it's very important that we need to assess and understand uh, how do you react to such a situation. As long as you're able to distinguish between what is permanent in nature or it's a temporary panic, you can actually capitalize on that part and act accordingly. Let me give you a recent example. The markets fell very sharply post the exit poll and the actual results. The question is, how do you react at that point? That is something which will actually determine whether you're a good investor or a smart investor out there. From a behavioral point of view, it is very important to stay very calm and rational whenever such a thing happens. And you should be able to distinguish whether this is a temporary event or it is a structural change which is actually happening. And then you need to act accordingly. So, those are the lessons that I've learned from the entire market cycle out there. I think in a bull market, it is very easy to get swayed by the popular perception. You tend to believe that this time it is different. That the earnings will continue to grow at the same rate till infinity. It never happens that way, right? I've seen how initially the IT sector, when it got listed, uh, the IT companies were trading at some stratospherical valuation. And all you had to do was use conventional cash flow measurement tools. And you would realize for them to be justified at those valuation, they would need to grow at least 25% till perpetuity, which is never the case. I mean, your terminal growth rate has to be at best aligned to the growth rate in the GDP. You can never have such a thing. Obviously, those were the things that you need to focus on. So, in a bull market, it's very important that you stay focused in terms of rationality and not get carried away by the popular perception.
Sir, as you mentioned, you have spent around more than 3.5 decades in the market. Could you just share with us what is your investment philosophy and what kind of markets or situations excites you?
So the investment philosophy that we follow at Baroda BNP is built up on three pillars, which we call the BMV principle, which stands for business, management, and valuation. So typically, when we look at a company, we focus on the business of the company. And when I talk about business, I'm actually referring to what is the moat that the company has, whether it's in terms of brands, whether it's in terms of technology or the ability or access to raw material, etc. And I'll just tie it back to the argument that why do I need to have a moat? Because I need to see sustainability and predictability in the earnings. The second M actually stands for management. And we're really not talking about corporate governance out here, which is taken for past because the moment it is a part of an investment universe, it is assumed that it has a reasonably corporate governance. When we are focusing on the management, we are really looking at what is the competence of the management out there. Competence in terms of how do they manage the business, how do they manage the volatility in the business. Uh, at every situation may not be as aligned to as their expectation. For example, how did the management react during the COVID time? How are they able to manage the supply chain out there? How do they treat the suppliers? Uh, that actually tells you how they're going to treat the minority, like institutional investors. Yeah. What is the depth in the management? And finally, we focus on the valuation. And when we talk about valuations, we are actually referring to the conventional form of we still focus on the cash flows, and that's how we evaluate the company. Uh, by and large, we are growth investors. That means we look at growth at a reasonable valuation. We follow a GARP philosophy in valuation, which means that I will not hesitate to invest in a company which is growing faster but trading at a relatively higher multiple or any valuation tool. And that ties me back to the business. And why do I need to have a moat in the business? Because I need to see sustainability of those earnings. As long as these earnings are sustainable, I would not hesitate to invest in a relatively more expensive company. And that is what ties me up in terms of the valuation. So that's the broad investment philosophy. Now, coming to your second part of the question, what are the themes that we are really excited about? So, as a broad philosophy, I think what the market is throwing up is the new energy theme, which seems to be a very interesting opportunity out there in the market. Initially, this theme actually emerged out of a compulsion where all the global all the countries in the globe decided to focus on the ESG principle. But right now, the way the cost structures are positioned, I think it does offer a viable standalone option out there. So the entire value chain of technology disruptors, chemical companies who are supplying to them, companies who are contractors out there, the companies, the utility companies themselves, the developers, the entire value chain offers a very interesting opportunity out there. Another theme that we really like, structural long-term theme, is we do believe that last decade was of the rise of the middle class. I think the coming decade is going to be the rise of the ultra HNIs in the country. The sheer growth numbers is going to surprise everybody. So that's something could be a very interesting consumer opportunity, whether it's in terms of the entire wealth management space or all the goods and services that a typical ultra HNI would be consuming could actually throw up some very interesting opportunities. So those are the two broad themes that we really like at these stages.
So there's a lot of debate about the mid and small cap segments of the market. Some say they are overvalued while others see growth potential. Sir, how do you approach these segments and balance the short-term volatility with the long-term growth approach? Because, sir, in the recent past, we have seen some of the stocks in the small and mid-cap segment going down by 40, 50%, 30% kind of thing. So what's your thought on that whole thing?
So this is true. In recent times, we've seen quite a bit of a volatility out there in the mid and the small cap, and the valuations are being challenged. I do believe that valuations have to be seen in conjugation with the growth, and they go hand in hand. I would actually tend to bring in another dimension of looking at how profitable is the growth, and therefore come to return ratios that we should be tracking for each of them. In recent times, we've seen a slowdown in the earnings, and this is more pronounced for the mid and the small cap space. Uh, we've observed that whenever there are any global events, and we've seen that during the global financial crisis and the COVID times, that whenever there's an external led slowdown in earnings, the mid and small cap tends to decelerate much faster than the large cap. And I think that's something that we are witnessing even right now. So when you talk about should we be looking at this market cap uh, of small, mid, or large cap, it is actually a function of the time horizon that you should be looking at. So whenever these external challenges are there, as I mentioned, we tend to see a slowdown in terms of earnings, which could lead to volatility in the index performance. And hence, a large cap can be a very interesting option to explore at this time. However, having said that, India is actually a growth market. And typically, when the growth comes back, we've always seen the acceleration in the mid and the small cap earnings growth, which leads to a better re-rating or better valuation for mid and the small cap. So depending upon the time horizon that you're looking at, that's the position that you should be having for mid, small, and the large cap.
Right now, coming to your multi-cap fund, in a volatile market like the one that we are in right now, how do you approach allocation between the different market caps, large cap, mid cap, small cap stocks?
So it's a very interesting question because, in multi-cap, truly speaking, the regulators actually defined the allocation to large, mid, and small cap at 25% each. So the fund manager actually has a very limited leeway of allocating 25% to decide on where they want to place. The allocation is actually made through a very detailed analysis. In multi-cap in particular, we follow what we call a strategy of 4-3-3, which is an allocation to large, mid, and small cap. And I don't know if you follow soccer, that's the best attacking strategy that you have. 40% towards large cap, 30 to mid, and 30 to small cap has worked wonderfully well. Uh, while the mandate is 25, 25, 25, it does provide enough liquidity. It also provides adequate return, a risk adjusted adequate return that we have out there.
Sir, coming to the balance advantage fund, different fund houses have different allocations towards equity and debt depending on the P, price to book, various factors. Could you help us understand what signal prompts you to shift from equity to debt or debt to equity, vice versa? And how do you manage the risk with these dynamic allocations?
Sure, that's a very interesting question, and it's something which is very close to my heart. Baroda BNP Paribas Balance Advantage Fund follows a proprietary deterministic equity allocation model, which means that we run a model which is developed in-house, which tells us what should be the net equity allocation that we should be having to get the most optimum risk-adjusted return. So let's try to understand what is the heart of this model. We're using fundamental factors. There are multiple factors. We don't stick to one factor. We have four factors, which is P ratio, price to book, dividend yield, and earnings yield gap, which essentially captures the four dimensions of a company. That's the P&L, the balance sheet, the cash flow, and what is the alternative investment option besides equity, and what are the relative valuation of equity versus the debt. And that's how we actually make the model. And that determines and throws up a number, what should be the net equity allocation between 80 and 100% to say that that will be the best return model. Then we have a monthly rebalancing out there. Now, the risk mitigation is actually provided by the right allocation towards equity and debt. And it's based on the various valuation tools that I did mention. And it also accounts for the relative return potential from the equity versus debt. The clear objective of this fund is to deliver a superior risk-adjusted return with the fund allocating between the two major asset classes, that's equity and debt. In the last 5 to 6 years of the fund's existence, we have noticed that most of the upside participation, this fund has participated in most of the upside of the market and has protected the downside in a very significant manner. So, for example, during the COVID time, this fund captured all the upside post-COVID. But prior to the COVID, while the markets fell significantly, it participated only to the extent of 20% odds or so, while it participated to the extent of about 91% on the upside. So if you see the entire cycle, the returns which it has generated on a risk-adjusted basis has been phenomenal. The average equity exposure of this fund during the entire lifespan of about 5.5 years has been about 57% and has generated about 15 to 16% CAGR return. So on a risk-adjusted basis, I think it's done a phenomenal job.
Coming to the specific, the large and the mid cap fund and the multi cap fund, both the funds seems to be actively taking the sector calls with the opportunistic buying and selling. In this regard, if you can shed some light both on the fund strategies.
Sure.
What
So, I would tend to believe that as a fund house, we have done well, and many of our funds have done better than their peers. Both a large and mid cap fund as well as the multi cap fund stand out in terms of their pure performance as well as against the benchmark. So, let me just talk about the Baroda BNP large and mid cap fund at a broad level. The allocation towards the large and the mid cap has remained more or less static at about 40% each. It's the judicious allocation of the remaining 20%, which has led to a significant outperformance out there. There's absolutely no denying that the bottoms up approach towards stock picking in the mid cap is the one which has resulted in good outcome. The allocation to the small cap has also contributed to the outperformance out there. In case of a Baroda BNP multi-cap fund, I did talk about the flanking strategy of 4-3-3 in the large, mid, and the small cap, which is 40% towards large cap, 30 to mid and small cap. Managing the multi-cap has its own challenges because you not only have to make the right market cap curve decision, which is what we've decided in terms of the broad allocation that we have, but it is also a question that should we be allocating a small cap, which inherently is more volatile, in a more volatile sector ranking, or how do we want to look at it? It's a call that one will have to take to decide, do we want to make the fund a lot more volatile depending upon our view on the market out there. So the outperformance in the multi-cap is not only led by the right market cap allocation, but also the allocation to the sector and the stock in a particular sector, which has led to an outperformance out there. So our focus is always to deliver the best class and return, accounting for the risk that we are taking in the fund out there.
You spoke about the bottom up stock picking and this allocation towards the small cap and the mid cap has that worked well for the fund. But could you just put a light on what are the sectors calls which has gone right?
Sure. So I think the biggest thing is the kind of discipline that we have towards research is what makes a big difference. How are you analyzing the companies and how are you acting on the analysis that you have done? That is what makes a big difference in terms of the approach per se. In the last 12 months in particular, I think our overweight call in industrials has worked very well. Our call of going underweight on IT had also worked very well. We have been, in general, underweight we've been neutral on the consumption, but being underweight on staples and being overweight on discretionary consumption like automobile has worked very well out there. So those are the key sector-wise attribution which has worked very well. Of course, there have been stocks which have done extremely well for us.
Right now, we're just curious, given the strong performance of several of your funds, is there a broader strategy to leverage this success and attract more investors?
So as an investment manager, job is always to deliver returns which are aligned to the investor's interests. And as a fund house, we always focus on our risk-adjusted returns. So platform like yours would actually help us to address and communicate our strategies to potential investors. Given the size of our fund, almost all our Baroda BNP Paribas funds are in a very sweet spot where they are small enough to offer agility to the investors, for the fund managers, but large enough to attract enough attention. So, and this is also backed by, of course, the time-tested investment processes that we follow to deliver consistent performance. I would rather have the investors look at a process rather than focus on the performance, because performance is always an outcome. As long as the process is consistent, the outcome is likely to be more desirable. So, what can the investors expect from us? They can expect a disciplined approach to investment driven by a process which is applicable to all our funds, and we hope to deliver consistent returns aligned to the investor's interest.
Sir, you hold a few of the new age tech companies in your portfolios that has done well in the past. What's your outlook on the future of the e-commerce in India, given the mixed results we have seen in the sector in the past?
So when we are looking at any company, we tend to examine all companies through the three pillars that we spoke about. We examine the business, we look at the management, we look at valuation. The nature of ownership or the technology is not really a key determinant out there. So when we are valuing a company, we actually focus on the cash flows. Some of the platform companies or the new age companies that you refer to, uh, in a routine research, we found that the operating models for some of these new age companies had changed for the better, resulting in faster and superior cash flows, and that warranted an investment in them. As a fund house, we continuously monitor all the companies, uh, whether they're new age companies or platform companies, which are all part of the investment universe. If there's any change in the business dynamics, where they're becoming more profitable or they're getting a better margin, then that's the time we'll take a call to invest out there. Specifically in the case of new age, you have to be a little more careful out there, because a lot of these companies have their profits which are not in the near term but are uh, far ahead into time. So as a policy, we try to identify companies where the cash flows are having some near visibility and not too far away into the future. So most of the companies can be justified based on cash flows beyond what we call the definable, projectable time period, which is beyond 5 years. There's a fair degree of uncertainty and unpredictability of the cash flows that the company is talking about. So we really focus on more on the near term 3 to 4 year cash flows rather than over a long period of time. And that actually brings in a bit of a risk out there. So these kind of companies require a lot more monitoring. And if you catch them right, which is what we have done in most of the platform companies that we own, the returns can be far above average. And that is what we've seen.
And sir, what's your overall view of this segment in India over the next 5 to 10 years?
So I think these platform companies, I think India's got some very great uh, thinkers and minds who've been able to develop new technologies. Uh, the business environment is right because the technology backbone has been set very effectively. Uh, the adaptability of the people is also very high. Uh, and people are willing to pay for the services that they're getting. So it's a very ideal combination where you have a demand, you have the right supply at the right price, and people are willing to pay for that. And they're going to be profitable. So it's a very interesting business proposition out there. We just have to make sure that you're not too early in that stage where the technology disruption can change your entire business model all of a suddenly. So you need to distinguish whether it's a right candidate for a venture capitalist or for a publicly traded company.
Right. Well, With that, it's time for us to wrap up this chat. Thank you, Sanjay, for taking the time for this interaction. Thank you.
Thank you. Bye-bye.
Thank you, sir.